Alright, day 48 of my journey to a $500,000 stock market portfolio. So I really cleaned up my positions in my margin account. As you can see, they all fit on one page. I closed a lot of positions. I'm trying to keep only SPY put spreads. Obviously, the position that I can't close for a profit yet, I'm gonna continue owning, but my goal is to clean it up and just end up with SPY put spreads and maybe some earnings trades here and there, or anything obvious. So for now, in terms of covered calls in my margin account, plus I don't want to hold shares in my margin account because there's interest in the margin account when you own shares. I only want to do credit strategies where I'm collecting a credit to open the trade in my margin account so that I don't have to pay any interest. In my registered accounts, I could own shares. So I don't want to do covered calls in my margin account, but for now, I still have to keep the covered call trades because they're not ready to be closed. For example, American Airlines is trading at 28. My cost is 31 and I've got a strike at 30. So there's nothing I could do but continue holding it. Box, same thing. I've got a cost of 20. My strike is 20, but the stock is trading at 15.45. Dell is close. I could probably close Dell soon. My strike is 52.5. My cost is 52.8. So if it's trading above 52.5 next time, I could either close the trade or maybe sell another call option. Again, really depends how much I can get for it. I probably will be tempted to sell a call option, but I think I should close it just to avoid paying interest in this account. The interest in the margin account with questrade is quite high. It's almost 9%. I still have this DIA put credit spread expiring February 21st, so it's got 11 days to go. It's showing a small profit. It was showing a better profit on Thursday, but then of course on Friday when the market dropped at the end of the day, that didn't help. But it's showing a small profit right now, and I still have 11 days to go, so it's not in a dangerous position. I mean, my short strike is 285 and the ETF is trading at 291, so I would say it's somewhat safe. I closed a lot of put spreads actually on DIA, Facebook, IWM, SPY, the Qs, but I'll show them in a different video because I want to make a video showing all my trades or all my closed trades for the month of January and then once again for the month of February. So for now, I'm just showing what I currently own in my portfolios. So I still have Facebook. I was able to close one of them that expired February 14 for 50% profit. So this one I still own. It's showing a small profit, as you can see, of only $5. It's got 11 days to go. I collected 70 cents initially, so I'm trying to close it for 35 cents. I've got IWM with a short strike of 162.5, and right now this ETF is trading at 164.88, so it's kind of close. At some point it was in the money because IWM was trading at 160 at some point, but the market recovered quickly, and right now it's relatively safe. It is currently showing a loss position, but as we get closer to the expiration, as long as it stays above 162.5, I'll have a better chance of closing it for a profit. Facebook has a short strike of 205, and right now it's trading at 212. So it's safe. It just needs some time to pass by so that I can close it for a good profit. Now I've got 4. I've got 4 put spreads on the SPY. I closed a lot. The 2 that I'm waiting to close is this one here, February 21st and February 24th. This one I collected 60 cents. This one I collected about 70 cents. So I'm trying to close them for half the profit. So they're showing profits, as you can see here, 68 minus 55 and 212 minus 172. So they're showing profits if I close them now, but they're not showing 50% profit, but they're very close. So it's just a matter of the SPY to continue going up or for time to pass by. They have this one here, the February 24th has 14 days till expiration, and this one here has 11 days till expiration. And this week I opened 2 new SPY put credit spreads, one expiring March 6th and the other expiring March 9th. The one I opened on March 6th has a 324 short strike, so obviously when the market dropped on Friday, that didn't help me. I'm in a losing position on that one, but I've got 25 days to go. The one I opened expiring March 9th, I opened it yesterday actually on Friday. It is showing me a neutral position, so it's not winning, it's not losing. Break even position, I've got 28 days to go. My short strike is 321, and right now the SPY is trading at around 331 after hours. So I still have time, and there's still a lot of margin between there's still a lot of room between 331 and 321. So Uber went up, so that should be a good thing since I bought the stock at 40. But the problem is I sold a call option at 32. So now I'm stuck losing my shares at 32 while my cost is 40. So that's what happens when you sell covered calls at a strike lower than your cost. When I sold this call option at a 32 strike, Uber was trading probably at 28 or something, but then it just went past it, as you could see, and now it slowly went past it, and now it's at 40 after earnings. So kind of in trouble. I'll have to roll it out in the future. I could still roll it out for a credit without paying anything for it, but it's going to be really out in the future, maybe like a year out. So that's what sucks about it, but I have no choice. Got a lot of positions like this. And United States Steel, I still own 400 shares. I'm down almost 50%. I'm trying to sell a call option against it, but I'm collecting like maybe 10 cents, and I'll have to choose a strike of maybe 11. And the problem is I could end up in the same situation as Uber. If United States Steel jumps above 11, my cost is 18 and I'm stuck losing my shares at 11 just for collecting 10 cents. So that's the dilemma I have right now with United States Steel, is I don't know which strike to sell call options against. So in my TFSA, all covered call trades. Afria, terrible. CHK, terrible. Grubhub, it dropped after earnings. So it's good and bad for me. First of all, it's bad because my cost is 74. So it sucks that it's trading at 50. So I'm down on the underlying shares. But it's good because I sold a call option at a 50 strike expiring February 21st. So Grubhub was trading at 55, 56. So that put me in a bad position because I'd be stuck selling my shares at 50. But now that it came back down at close to 50, now I'm in a safer position in terms of the call option that I sold. I'm not stuck losing my shares at 50. I could easily roll this call option out to the future. Even at a higher strike, I can go to a 55 strike and still collect the credit. So in that sense, I'm happy. Got Halliburton here expiring next week, Friday, at a 22.5 strike. I'm going to try to, if I can't close this trade, so if Halliburton is trading below 22.5, I'm going to continue owning these shares, and I'm just going to sell a call option at the same strike. But I would prefer to close this trade, get my capital back, and use it towards something else because it's not doing anything special for me, this stock. IMGN is a terrible covered call trade. I don't even want to talk about it, but I'm trying to salvage any premium I can get before I end up losing my shares at $3 when my cost was 5.7. Neo, same thing. Q's, that's a new covered call trade I did. So last, I think January 29th. I placed this trade on January 29th. I bought 100 shares of the Qs and I sold a call option at a 220 strike expiring February 7th. I collected about $4 of premium, but the stock was trading at 222 when I made this trade. As you can see here, 222.31. I sold a strike at 220, but I collected $4 in premium. So my net profit on this trade, if the Qs is trading above 220, is $2. So I guarantee a $2 premium by February 7th if the Qs was trading above 220. The Qs was trading at 230 February 7th, so I could get my capital back plus that $2 profit. But I ended up just rolling the call option to the following week, so February 14, at the same strike, and I collected $50. So as you can see here, I collected 50-cent credit just to roll the call option till next week, just to see what happens, because I don't know if the market's going to continue to drop next week, but that represents about a 11 to 12% return per year, that 50-cent credit that I received. I'm aiming more for a 20%, so I should have gone for a higher strike, maybe 222 or even 225. But just in case, if I went for a 225 strike and the Qs decide to drop all the way down to 220 like it did last week, I'd be pissed. So I stuck with 220 just to see what would happen, because I think the market's going to drop next week. Why do I think that? Just because the way it ended on Friday and because of the crazy rally we had this week. All right, so Teva is another covered call trade. My average cost is about $15. I sold a call option at an 11 strike. Right now it's trading at 12.16. So I risk losing my shares at 11 while my cost is 15, but I could easily roll this out to the future for a higher strike. So I'm not too worried about it. It is in a losing position. It is in a losing position right now, but I can recover the call option easily by rolling it out to a higher strike, maybe 12 or 13, and collecting a premium for it. But I'll have to go out in the future, of course, maybe 2 months. So in my RSP, they're all covered call trades as well. I had Bombardier that I bought at 1.82 and it dropped all the way to maybe 115. So I sold a call option at $1.50 strike. So I sold a call option at a strike lower than my cost of $1.82, and on Friday it was trading at 149, so it was very close of going above my strike, which is something I don't want because I risk losing my shares at that strike, while my cost is 182. But I was lucky it stayed at 147. It closed at 147, so whatever I collected from selling that call option at 150 I kept, and now I can sell another call option, and this time because the stock is higher, I will most likely choose a strike of $2 just to be safe and not to lose my shares below the cost, the purchase price. Because when you sell a call option against your shares, the consequence is losing your shares at that strike price. So you need to choose a strike price that you're comfortable selling your shares at, but at the same time, the higher the strike price, the lower the premiums you collect. So it's a trade-off. So L Brands, my cost is 26.2. Right now it's trading at 23.5, so that's good. But the problem is I sold a call option at 22.5, but I think I can easily roll it forward. I still have until February 28. I'm going to see what happens. I'm not going to take action right now. Novavax, terrible covered call trade because the stock dropped so much. Bought it at 32 and right now it's trading at 6.3, and I've been selling call options ever since. I've collected a lot of premiums on it, but not enough to compensate for the $32. Square was a good covered call trade. I've collected a lot of premiums on it. I bought it at 69. It dropped all the way down to 58, and I've been selling call premiums every month. And now the stock rallied up to 78, even 81 at some point. So I can actually close this whole trade and get my money back for $69, which is my strike here because I sold a call option at a 69 strike expiring February 14. Or I could continue rolling the call option forward. But I would, in this case, I'd rather get my capital back because I want to use it towards something else. And Yeti, same thing, same exact position. My strike is 33, and this is a good trade because it's a profitable trade. This is the strike that I'm willing to sell my shares at, so I've got no problem with that. I have two choices. I could continue to sell a call option at a 33 strike for a credit, or I can get my money back at a 33 price, which is probably what I'll do because I want my capital back. And then in my RESP, I've got Bombardier at a 225 strike. This is something I want to get rid of. I want my money back and I want to use the capital towards something else. I'm not sure what I want to do with it yet. I mean, I don't have that much in my RESP. I've got about 6,500 US. So in my registered account, really, I've got two choices that I want to do that I'm comfortable with. It's either covered calls, but covered calls on ETFs. So, and the three ETFs I'm willing to do covered calls on is SPY, Qs, and IWM. But obviously I don't have enough to do 100 shares of the SPY, the Qs, or IWM. The closest thing would be IWM, but I don't have enough. My other option I think would be to buy call options 2 years out, like I did with McDonald's, because I think it was a good trade. As you can see here, I bought a call option on McDonald's 2 years out, expiring January 21st, 2022. I bought it for $14, and then 7 days later, so a week later, I sold it for $19. So that was a good $500 US profit. So these would probably be the trades that I'm willing to do in my RESP account, but the thing is I have to wait for opportunities. I have to wait for something like McDonald's or MasterCard or Visa to drop considerably, and then I can safely buy a 2-year call option because I'll have a higher probability of selling that call option for a profit. Or I could buy dividend stocks, but for me it's just too boring. Or I could also just buy the ETFs and keep them. I mean, this is a long-term investment because it's only cashable in 18 years. So if I look at the SPY, let's say for the past 5 years, you could see that it would have made a decent return, right? If I just bought the SPY and held on to it. 332 divided by 210. So it would have made an average of 11% return per year if I just bought the SPY, and that's in 5 years. So that could be another possibility in my RESP account since it is a long-term investment. Just the thing is, buying the SPY in 2020 when it's at all-time highs versus buying it in 2015 is probably not the same thing. The next 5 years might not be the same as the last 5 years. I mean, the SPY has had 5-year periods where it was just flat after 5 years. So who's to say that if I buy it now in the next 5 years, it's not I don't get a 0% return. That's why I don't necessarily like the buy and hold strategy. I'd rather do something, look for a strategy that generates some sort of profit or income, even if I'm not successful at it all the time, but just that's what I have to try. All right, so this was a quick overview of my portfolio. If you have any questions, leave them in the comment section below. Don't forget to like, share, and subscribe. And if you can open an account with questrade to trade on the stock market, use my referral code in the description below the video to get up to $250 back. Thanks for watching.